Okay, so we start with our new topic, which is topic 7. Interest rate and interest rate risk. Right. So I am planning to give 2 sessions to this topic, but we will see how fast we go. If we cannot finish everything in today's lecture, then we have another class on Thursday, so we will do some other things on Thursday related to this topic. Really? Yes. I sent to Min this. Did you receive? No? Okay. How come? Look, I put in the group. See, topic 7. Today I sent, I don't know, today 1:30. Here. This one, right? Min, top of this. Min, did you forward?
I forget that. So sorry.
You are here, right?
Yeah.
So I know where I'll send them from here.
Team Ho Chi Minh, you say?
Hanoi, I already sent them, but
Yeah.
City, I'm sending now.
I sent it.
Did you send it? Okay.
Yeah, I just sent it.
Because I want to finish after, because this is your second last topic. As I mentioned that you will have total 8 topics. So this topic would be your second last topic. So I want to finish this topic earlier. So, but of course, I'm not saying that I will really rush to finish this topic, but we will give sufficient time to finish this topic. Then finish topic 8. After topic 8, whatever time is left, 1 session or 2 sessions, we will spend all those times to do some revisions, questions, right? From the topic, since topic 1 to topic 7 and 8. And I hope this Saturday, I will try to give you idea about your examinations. I'm not sure. Again, I will give you some idea about your examinations, that which types of topic most likely to be covered in your exams. So you can pay more attention to those topics. But again, if I'm saying that these topics are important, but it doesn't mean that the topic that I'm not talking about, which will not be part of your exam. Of course, that topic may be part of your exam, but I will give, I will say that please be focused on these topics. All right, means if you start giving revisions, you give importance to those topics. All right, but again, I'm not saying that other topic would not be part of that, but that topic most likely to be covered in your exam. All right, hopefully this Saturday I will talk about your exam structure, and I hope by this Saturday we would be finished topic 8. So means my plan is to, because Saturday we have 2 sessions, morning and afternoon, and next week Monday would be the last session, right? I think next week, Monday, would be the last lecture. So my plan is to finish everything by Saturday morning. So means Saturday afternoon, we will do revision, and Monday, we will also do revision. So we have a 6 hours for revisions, totally revision, 6 hours for our 6, 7, 8, whatever topics we have, all right? So plus, office informed me that you think that your examination is really far, it's too far for you. I mean, in October, I agree with you, it's too far from your finish date of this course. So I asked office to confirm your exams again from your UK module leader. If he's agreed to prepone exams date, then probably your exams could be 2 weeks after your finish dates. Is not my idea. It's between, regarding your exams date, we have to confirm with, not we, staff has to confirm with the UK module leader first, but he already informed me that after 21st of October, you will have exam. But if you think that 21st of October onwards is a too late, because you are finishing now end of July, and August, September, and probably October, 3 months time period. If you think that it's too much, then you speak to office and you can change your exams date, maybe September or end of August. End of August, I think for me, the ideal time period would be end of July. I think end of August would be the ideal time period. You should not delay further, in my opinion, but I don't know whether we have a right to change our exam date or not. So hopefully, I request office to drop email to Richard in UK. So he will confirm that, right? So once he confirmed everything that, okay, it's up to you, whenever you like to give exam, you can give exam, then we will decide. I mean, not we, I will not decide at all. You guys will decide, all right? You can vote and you can discuss with each other and come up with a common date, and then you vote that, right? So again, as I said, if you ask me, 3 weeks would be sufficient time period, in my opinion. So means if we are finishing July, end of July, so last week of August would be perfect time.
But the schedule we can see is after this, we have another.
Okay.
And after 2 weeks learning, we need to skip the
assignments. What is the deadline for assignments?
2 weeks after the last day of
the course. So when is the last day? It's like a global management, right? The global management.
Yes, it's 14th of August.
14th of August. So means end of August, you would have to submit your assignment. So you can keep it first week of September. First week of September, I think it's okay if you want to keep this. No, again, it's your choice. It's your decision. You have to give priorities to the other subjects as well, and then we will decide. But again, if you don't have to really study one day before your exam. If you're doing on every weekends, you're doing some revisions, more than enough. More than enough. Every weekends, do 3 hours, 4 hours, 6 hours you spend on this subject would be more than enough. All right. So yeah, so it's your choice to decide. So now we start with our topic 7. So topic 7 is about your
end of August is okay, but if end of September I'm not able to join, please don't be the first week of, again, I'm not sure about the exams date. So once we receive any information from UK lecturer, then we will decide. I mean, not I will not decide. I will not decide your exams date at all. You guys will decide, or maybe office will decide. You speak to office. Once you agree with your exams, then you come up with the date. So I have no involvement in your exams dates. So we will see. We will see. Of course, we will ask you first. We will not choose one random date and then we will give it to you. So you guys will discuss with each other, and whatever suitable dates available for all of you, then we change it. All right. All right. So interest rates. So before we start, directly jump to the estimation of interest rate or the idea of interest rate things, let's have a look at the types of interest rates. Types of interest rate. So there are two types of interest rates. One is nominal, and the other one is a real. Nominal interest rate and real interest rate. Nominal interest rate means the rate or the price paid or received by borrower lender. You go to bank to borrow money, or you go to bank to deposit money. Bank says that 6% is the lending rate or 6% is the borrowing rate. That rate called nominal rate. So means whatever rate bank is offering you, that's called nominal rate. All right. Nominal means the rate we pay or the rate we pay or receive. That's called the nominal rate. And real interest rate. Real interest rates are the rates, those represent the difference between nominal rate and the rate of inflation, right? Real rate, real interest rate represent the difference between your nominal rate and inflation rate. So this is called real interest rate. So what does it mean? What actually means it? What is the meaning of this? It means if you go to bank to deposit money and bank says that we are offering you 7%. So means your money will increase by 7%. But in the market, inflation is, let's say, 3%. This is nominal rate. And 3% is inflation in the market. So inflation rate is the rate that reduce the value of money. All right. So means, what is a net increment in your money? Just a 4%. So 4% is the real rate. That's the meaning of, in reality, your money is increasing by 4%, not 7%. Right? So this is the difference between nominal rate and the real rate. That's the idea between nominal and the real rate. So now let me show you example of something. So, for example, this is example. If a nominal rate of 10% is quoted and inflation stands at 7%, the real rate is 2.8%. So I think I directly gave you the answer, but let me show you. For example, let's say we do not have information about real interest rate. We don't have that information. So how can we estimate our real interest rate? So we call them Fisher formula, or the idea to estimate your interest rate is 1 plus R equals to let me change something. So it's 1 plus I equals to 1 plus H multiplied by 1 plus R. I is your cost of capital, right? I is your cost of capital. H is your inflation rate. H is your inflation rate. And R is your real cost of capital. Remember one thing, if I say cost of capital, it means it's a nominal cost of capital, because as I said, when you go to bank to borrow money, bank will charge you rate of interest, we call 7%. So bank never say that this is nominal interest rate. Bank normally says it's a interest rate. So I is your cost of capital and R is your real cost of capital. If you solve this equation using these two numbers, all right, using these two numbers, so it means 1 plus your cost of capital is your nominal interest rate, which is 10%, 1 plus H is your inflation, 0.7%, and R we need to calculate it. If you solve this equation, you come up with your 2.8% is your real interest rate. I think these kinds of things we calculated one time. Did you remember this estimation? When we were discussing about free cash flows in your valuation method, in free cash flow, we have a one question about weighted average cost of capital. I remember that, I guess. We did something like that. So let me go back and check. Here, yes. That's what we estimated last time. Here. Can you see that? Can you see that? This is the Fisher formula that we are applying to estimate your rate. We did the same formula that we applied. 1 plus R and H. 6% is your inflation, if I'm not wrong. 6% is your inflation. It's the same thing. It's the same formula. So this is a Fisher formula. Fisher formula, topic 7. Topic 7. All right. So which means 1 plus I equals to 1 plus H, 1 plus R. H is your inflation. All right. H is your inflation. And I is your probably cost of capital. Right. I is your cost of capital. Cost of capital. Or you can call it weighted average cost of capital. Weighted average cost of capital. R. If you solve this equation, I is 16.6, H is 6, and if you solve this equation, we come up with your interest rate, which is nominal interest rate. All right. The same thing for this topic that we did it. I think you have this file, so you can change, or I will send you this file again, so you will remember. Okay, so this is the basic idea about nominal and real interest rate. Now move on to the next factor that affecting interest rate. Factor affecting interest rate. Factor affecting interest rate. So first of all, government policy influence your interest rate. Government policy. Have you heard about two types of government policy? We call them monetary policy and fiscal policy. Have you heard about it? Monetary policy and fiscal policy. Have you heard about this monetary policy and fiscal policy? Monetary policies are policies that decided by central bank or state bank in Vietnam. All right. What is the purpose of this monetary policy? The purpose of this monetary policy to control over supply of money in the market. How much money
should be flow in a market or how much control we should give on the money, because you know that with the help of monetary policy, government control inflation. Because if the supply of money increase in the market, inflation will increase. Because supply increase, value of money goes down. Value of money goes down means inflation is up, vice versa. Right? So this is called monetary policy. So if government want to increase supply of money in the market, because government believe that there is an investment opportunities in the market, people are looking for money to invest it. So what government will do? Government will reduce interest rate. Interest rate reduce, your cost of capital reduce. So everybody start borrowing money because their cost is low, borrowing money is low. If government think that supply of money should be stopped because value of money is depreciating, is reducing, so government will increase interest rate. So this is the involvement of monetary policy to decide, determine, change interest rate. Next one is a fiscal policy. With the help of fiscal policies means budget. You know budget things? Budget means how much money government going to spend in this country on different items, different sectors, education, health, and blah, blah, blah. So this is called fiscal policies. With the help of fiscal policy, government also control interest rate. Because in the fiscal policy, if government budget is deficit, deficit means when your surplus are less than, your outflows are more than your inflows, then you have a deficit, lack of money. So in order to, if government has a deficit, they may increase interest rate. So as a result, government borrow more money from financial markets. So means the idea is that fiscal policy is another kind of tool that help government to change or control over interest rate over the period of time, right? So these kinds of government policy influence the up and down of interest rates, right? Next one is investor expectation. Investor expectation about future. Investor expectation for future. If investors believe that interest rate will rise up in future, they probably increasing the demand for it, because in order to pay for the in order to increase their purchasing power, in order to maximize their profitability benefits, they will invest. So it's all about investor expectation, and how investor they predict that may not be part of this topic, but we will talk about some kinds of trends. So means investors use those trends, upward trends, downward trends, or flat trends. Based on those trends, investors comes into various contract to reduce or mitigate the impact of interest rate risk. All right, that we will discuss later. Probably you know hedging, forward rate agreements, FRA. I don't know whether you know that or not, but that thing we will study in this topic. All right. So the idea is that investor expectation largely influence the movement of your interest rate. Next one is investor expectation on inflation. Investors' expectations on inflation.
investors expect that inflation will rise, what they will do? They will demand for high interest rate. So they will probably demand for high interest rate, or they go to bank for deposit money. If banks are offering them low interest rate, they may not choose that option. They will go with the other options. That probably low interest rate will discourage investors to deposit money in a bank. They may go with the other options because, again, inflation that reduce the value of your money. If inflation is 3% and bank is giving you 2%, there is no reason to deposit money in bank, because if you deposit money in bank, your value is eventually reducing by 1%. So there's no any point. So investor will go with the other options. So that's why banks may be encouraged to increase interest rate. It depends upon the what investor expectation towards the bank, right, or other financial institutions. Next one is a profit of intermediaries. Profit of intermediaries. Remember intermediaries, financial intermediaries that we study in our topic 2, I guess, in financial management. So, for example, banks. Again, banks, what they do, people deposit money in banks, bank use that money to lend to someone else. So if bank is offering you 6%, bank is expecting more than 6% to lend to someone. So means in order to maximize their profit margin, banks may increase interest rate, but not as high as they can. Generally, standardized interest rates are decided through the state bank with the help of monetary policy, and bank have some very minimum scope to increase or decrease interest rate. If the central bank is deciding 6% lending rates, bank cannot charge 8 or 9%. There is a small margin. It depends upon banks. So central bank leave it on that. So banks can take benefits of that small margin by increasing or decreasing. If they believe in increasing their profit, they increase interest rate. If they believe in client acquisition, means they want to acquire more and more clients, they may keep little bit lower interest rate comparatively other banks. So it's completely their action, what they prefer, profit or clients. Another one is a global interest rates. If I talk about global interest rate, I mean to say here two major markets in the world, which are US and European Union. So these are the two major biggest market in the world. So if those increase interest rate, other countries may have to increase interest rate or decrease interest rate, because if those countries are increasing interest rate, it will affect investor decision to make their investment towards those countries. So once these two major markets, biggest market in the world in terms of investment economy point of view, if those economies are changing their interest rate, that may influence other country investors to prevent any kinds of cash outflow from their country. So they may have to increase the interest rate. So these are the factors that maybe we have some more factors, but we are discussing very basic minimum factors that influence the interest rate. Now let's move on to calculation part. So this is the very simple things. So before we move on to our next topic, next part of the topic, anybody has any question? No question. So now we move on to the next, which one is a term structure of interest rate. Term structure of interest rate. Term structure, it has another name. Sometimes we call them term structure of interest rate, or sometimes we call them yield curve. Term structure or yield curve. Now, what does it mean, yield curve? Yield curve is a curve. You know curve? You know curve? Yeah, curve is a kind of graphical representation of movement in something. For example, this is curve. This is curve. This is curve. So curve is a graphical, it's graphically represents something. So with the help of curve, we find out the movement of something, all right? So yield curve is a graphical representation which shows the relationship between your interest rate and different maturities, right? I repeat, yield curve. What is yield curve? It's a graphical representation of the relationship between your interest rate. I write here yield. Yield means earn, receive, all right? So graphical representation, yield curve means earning. Right? Graphical representation of relationship between interest rate that you earn and the different maturity paths or different maturities. All right. Later, I will show you that's graphical representation. Now, what does it mean, graphical representation? This graphical representation shows that how much interest you are receiving. For example, let's say this curve, all right, upward curve. This is the time. This axis is the time, and this axis is your rate. All right. For example, 0, 1, 2, 3, 4. 4 is your T. Time period is 4. This is your yield curve. What this curve is telling you. So this is your interest rate. This is your interest rate. This curve is showing you the movement of your interest rate throughout your investment. I repeat, this yield curve is, we have three types of yield curve: upward, downward, and flat. We will discuss later. So yield curve is showing you the movement of interest rate over the period of your investment. In the 4 years, that was the movement of your interest rate. All right. So based on those kinds of yield curve,
and we assume market is stable, can we predict? Can we predict the future movement? Yes, of course. That's we always do that. Based on when you make prediction of something, what do? You look at the past records. You look at your historical performance. So that what exactly apply here that we will discuss later, right? So means this is also called the term structure of interest rate. If the term is short, interest is less. As term means the period. As your term of your investment is increasing, your interest rate is increasing. Your yield, interest rate, not the interest that we borrow, interest means that we are receiving. Deposited money and then you receive it, right? So this is the meaning of your yield curve. Now, okay, let me explain you some other terms before I discuss more about this term structure. Some terminology. For example, everybody knows bond. You know bond, right? Bond is a debt security or debt instruments, financial instruments, right? Now, coupon rate. Let me explain you these terms. Coupon rate, coupon payments, whatever. Interest rate. Interest rate, we can also call it market value. Market value. Bonds. We have generally two types of bond. One called redeemable and the other one is irredeemable. Redeemable and irredeemable. You know the difference between redeemable and irredeemable? Redeemable means the bonds which has a life. Means the bond which has been issued for specific period of time. And issuer, the person who is selling the bonds, may buy it back before its maturity period. All right, means it has a life in a very simple language. All right, bond which has a life can buy it back before its maturity period. Irredeemable are those which has a no life, no maturity period. We also call it callable bonds, right? No life, no maturity. I don't say no life, but I will say no maturity. Remember the word called annuity that you study in your financial management, annuity? Annuity means annuity. The new students, what is annuity? What is annuity? What about annuity? We just finished last week, and today you did your exam. Annuity. No, sorry, not annuity. Sorry. Perpetuity. Perpetuity.
Perpetuity means unlimited life period. There is no any maturity period for that particular investment. So means if you are holding irredeemable bonds, you receive lifelong interest, right? You receive lifelong interest. We call it irredeemable, yes, irredeemable bonds. Now, what is coupon rate? Coupon rate is the rate that we receive when you invest money in bonds. I repeat, I am a company, right? I need the money. I'm an issuer. I'm a bond issuer. I will issue bond to you. You buy bonds, and I will sign a contract with you to pay you interest every period. So whatever interest I pay you, that's called coupon rate. That's the meaning of coupon rate. All right. Now, what is market value? Market value means the market interest rate. Market interest rate means maybe my issuer is giving me 8%, maybe market giving me 10%. Whatever rate is available in the market, that offering the rate to the buyer, we call it market rate. So normally you receive interest on bonds called coupon rate. All right. Market rate means, so coupon rate means the rate we receive on the purchase of bonds. Purchase of bonds. So means once you purchase bonds, whatever interest you receive, that's called coupon rate. And market value or market rate, interest rate in the market. Interest rate in the market. That is your market rate. Now, let me show you a question. Then I will solve that question for you. That question is also in your slide. So if you open your slides, you can see this question in your slide as well. Like as if you open this slide, it's in your slide. All right. Practice question 1 in your slide. So now the question is, an irredeemable bonds issued some year ago at 100 pounds with an 8% coupon. So means you receive 8%. Market interest rate for similar investment are now 10%. Means
if you invest in a market, same kinds of investment that will give you 10%. So this is your 10%, right? You are receiving this one, but market is offering you this rate if you would have choose that option. All right, so that's the meaning of market rate. The rate that you do not receive, market is offering you whatever rate you are receiving, that is your coupon rate, right? Investor would not pay £100 for bond that paid £8. Anyway, just ignore the last. It means the perpetuity things. So investor would not pay £100. It means investor will never receive £100 because it's a lifelong bond. It's an irredeemable. Irredeemable means perpetuity, right? And quickly, our students, new students, tell me what is the formula for perpetuity. If you calculate present value using perpetuity, give me formula quickly. You study in your financial management. Formula for perpetuity. You just finished. Don't look me like that. Just give me answer fast. It should be like this. You're looking me like as I'm talking something else. Remember 4 types of cash flows we studied? Single period cash flow, right? Annuity, right? Perpetuity and mixed stream. So I'm talking about perpetuity. The formula for perpetuity. Yes, PV. Cash flow divided by rate. Yes, because no time. That's why no R. Normally, what is the formula for present value? Present value equals to cash flow divided by 1 plus R T. Right? But perpetuity, unlimited time period, so no T. If no T, no this. So means PV equals to cash flow divided by R. What is cash flow here? What is the meaning of cash flow? What do you think? In this question, what is cash flow? Think again. What is the meaning of cash flow here? What is cash flow? What you have to understand here first. What is cash flow means? Go back to your dividend valuation method. We use cash flow to calculate the present value of dividend or present value of stocks. So find what is cash flow here? What should be cash flow here? What is cash flow? Cash flow means the money you receive. That is your cash flow. What are you receiving now? Here. What is the rate? At what rate you are receiving now? 8%. So 8% of 100. So your coupon is £8. All right. What is R? 10%. So what is present value of bond here? So present value of bond is 8 divided by 10. So present value is
AD. Yes or no?
Yes.
Is that okay? So, what is the conclusion here? The conclusion is if interest rate increase, value of bond increase or decrease? I repeat, if interest rate increase, I'm not talking about coupon rate. I said interest rate. If coupon rate, I will say coupon rate. They are different. Interest rate is the rate that you are not receiving because you invest in this bond and bond is giving you 8%. How much is the interest rate? 10%. Means if you choose another option, you may receive 10%, but now you are receiving 8%. So interest rate is a market rate, all right? If market rate increase, your bond value increase or decrease? Decrease. Look, simple maths. If this 10% become 12, this 80 would be decrease. Yes or no? This is mathematical reason to answer this question. But we need to know the reason why. Why interest rate increase? Your present value of bond decrease. Means value of bond decrease. Because this is the rate you lose. You're not receiving. You choose this option, 8%. You choose, for example, I comes to you with this bond. I said, can you buy my bond? I will give you 8%. Right? And you said, okay. That time, market is giving you 10%. So how much you are losing? How much you are losing? 2%. Now, if market rate is 12%, then how much you are losing now? 4%. Is it good that you are losing? No. If I go to another investor and I ask investor, can you buy my bond? I will give you 8%. And investor quickly check, what is the market rate right now? And market rate is 12%. Investor say no. So means demand decrease. Demand decrease, value of bonds will decrease. That's why if market rate will increase, value of bond will decrease because nobody demand for your bond, because comparatively market, your coupon rate is very low. Who likes that kind of investment? Nobody. So nobody will demand for your bonds. As a result, value of bond goes down. All right. So remember that. Now I'll give you one more question. Similar question. Okay. Next one. All right. So here is your next question. Same slides. You have a second practice question on this slide. So calculate what you have to calculate here. Calculate the rate of return required by debt investor for this security. Same formula, but now number will be changed.
You have to rearrange your formula to get something else. You have a coupon trending is calculate and give me answer. Finished? How much? 7.27. That's right. So 7.27. So same formula, present value of bonds equals to coupon divided by market value rate. So how much is coupon? How much coupon is 8 pounds. And how much is market present value? 110. And we need to calculate this. So if you rearrange it, that would be 7.27. All right. So means your market rate is lower than your coupon rate. So means you are getting better than market. So probably it's a sign of your uptrend of your bonds in future because it's paying you better than the market price. Right? Any question or move on? Move on. Now we talk about we already talked about irredeemable bonds. I repeat again, under irredeemable bonds, you do not receive principal amounts unless you sell it. But generally, there is no any maturity period, so you do not receive principal amounts. You know principal amounts, the amount that you invested. Let's say I invested 100 pounds in that bonds. Is my principal amounts. Coupon is the interest that I receive. So this is irredeemable bond. This is the characteristics of irredeemable bonds. Redeemable bonds would be different. In redeemable bonds, you have a maturity period. So means, so let me explain you. So we were talking about bonds, then I think I should write here, talked about irredeemable here. All right. We talked about irredeemable here, and then we have B.
which is redeemable. So we talk about now redeemable. B. Redeemable bonds. Now, in redeemable bonds, you need to know two terminology. One, you know that, but let me tell you one more. One is coupon. Coupon. Coupon means return amount. Return amount means the interest that you receive on your bond investment. That's called the return amounts or coupon. You know that. And the other one is the redemption payment. The redemption payment. Redemption payments means principal amount. Principal amount. The amount that you receive with your interest. All right? Principal amount. Now, what will be the present value? Present value or market value? Like a perpetuity. Perpetuity formula was CF divided by R. But here would be different. In case of this, your formula would be a little bit different. So formula is present value equals to cash flow 1 plus R. Probably T, but it depends for how long you are investing. Let's say, for example, first year, second year, third year, so on. 1 plus R. I write here N, depends number, plus. This is CF. What is this? This is your coupon. Cash flow is your coupon, right? But you do not receive only coupon, but you also receive your principal amount. So, which is your, I don't know, we can write whatever you like, but you can say principal amount. I write here PM. PM 1 plus R. And whatever is your last, that would be same. For example, if this is 5 years, that would be 5 years because your investment will mature 5th year. So means 5th year you also receive your principal amount, right? So PM is your redemption payments. This is your principal amount. This is your principal amount. And cash flow is your coupon. This is your cash flow. All right. So this is the case of your redeemable bonds. So means sum of your present value of interest and your redeemable payments. Redeemable payments is your principal amount, right? So let me show you a question. So here is your question. You can directly insert this formula in your calculator, right? Depends how many number of years you have. For example, 4. So you directly insert 4 in that. So now here is your question. Bond pays 10% interest, 100 assume annual payments, and is redeemable in 4 years. Investor require 12%. Calculate value. So calculate the value of your bonds. What is your coupon rate here? How much is coupon rate? 10 or 12? 10. Coupon rate is 10 because bonds pay you. Bonds pay you 10. Investor require 10, 12. Okay. Remember one thing. Market rate, interest rate has a different name. I think I explained you before. But remember, sometimes we call it interest rate. Sometimes we call it discount rate. Sometimes we call it weighted average cost of capital or cost of capital. Sometimes we call it required rate of return, RRR. So this is your required. Right? It has a different name. Same idea. Finished? How much? Value. How much? Huh? 5.67 is the present value. How come? Your bond is already 100 pounds. So it's reduced to 5. I'm not saying that it will be higher than 100 pounds. No. But from 100 pounds, it's become 5 pounds. No. How much? No? How much? $30.37. No. You have to calculate for first year, second year, third year, fourth year. Okay. Huh? 60? No, it will not. It will not. Remember. Again, we go back to your financial management topic. This is your equal payments. This is your NUT. Remember NUT? This is your NUT. Ordinary NUT, NUT due. Remember that? Which NUT will give us high return? Ordinary NUT or NUT due? Which gives us higher return? Ordinary or NUT due? Study, today you had exam. Remember when we were discussing about present value, future value in your financial management class? We studied 4 types of cash flow: single period cash flow, NUT cash flow, perpetuity cash flow, and mixed stream. Right? NUT cash flow. In NUT cash flow, we have 2 types of cash flow: NUT due and ordinary NUT. So which NUT give us higher return? Ordinary. Why? Because, no, don't look there. The answer is not there. The answer is over there. End of the period. So we assume this is an ordinary NUT. Now you have 2 options. Option 1. If you remember your financial management subject, very nice. That you do not remember. So second option is you calculate one by one all cash flow. So you can write down like this. Let me explain. You calculate one by one and you add them all. So what does it mean? It means total time is 4 years. 0, 1, 2, 3, and 4. And how much is your cash flow? 10, 10, 10, and 10. But here you also have 100. What is 100? Principal amount. 10, 10, 10. So what you're gonna do? You calculate present value. Present value. Then present value. Present value. Present value. And present value. And then you add them all. Remember this way? If you don't want to do one by one, you go to your financial management class subject and you copy the formula. You have formula. All right? Or this is simple method. If you don't want to go with that formula, you can go. I think you go with this. Is much more clear for you. This is your coupon. You receive coupon. First year, second year, third year, fourth year. And fourth is your maturity period. Fourth is your maturity period. So on maturity period, you also receive principal amount. So calculate PV for this number. Then PV, 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 and PV. And then once you got all these number, 1, 2, 3, 4, and 5. Then you add them all. 4 years, discount. 4 years, discount. 3 years, discount. 2 years, discount. 1 year, discount. Yes or no? No? So, like this, still if you are not sure, this number, calculate PV for this number is 10 divided by 1 plus R is 12%. Time is 1. Then plus this number, which is 10 divided by 1 plus 12 times 2. Then this plus 10 divided by 1 plus 12 times 3. And then 10 divided by 1 plus 12 times 4. And plus your 100 divided by 1 plus 12 times 4. So see, that's what I was trying to explain you here.
69 or 89.
How much is this? Are you sure about everybody?
93.92.
Yes. It will be 93.3.4. 93.93 or 91. 93.93. I think 93, 91, but it should be 93. So remember that either you do this because of this reason or whatever, right? Yes or no?
Yes.
Move on. Okay, let's move. Now, let me show you not 3 types of curves that I was discussing before. Right? So, curve or yield curve. So one is this. And the third one is a flat curve. So we have 3 different types of curves. So that curves also given in your slide as well. So normal curve, inverted curve, and flat curve. So what is normal curve? Normal curve says that if you invest, normal curve says that if you invest for long term, it will give you higher return than short term. You can see that. Long term is giving you, if you have a look at here, long term is giving you 6%. Short term is giving you, if you invest for 5 years, you got less than 3%, but if you invest for 30 years, it will give you more than double. All right, so long term is giving you higher return than short term. Another word say that rates are less expected to change. Your normal curve shows that rates are less expected to change. It's more predictable. Next one is your inverted shape. Inverted shape says that your short-term investment give you higher return than long-term. The reason is why short-term is giving you higher than long-term? Because expectation of inflation decline. Expectation of inflation decline. Remember, if inflation increase, rate of interest also increase. If your inflation will decrease, rate of interest expected to decrease. Because of this reason, your curve is inverted, right? So, in other words, you can say that your 10 years bonds are earning less than 5-year bonds. Means 5-year bonds are earning more than 10 years. All right. That's another explanation of this inverted curve. Next one is flat. Flat means your short term is equals to long term. No difference. 5 or 30. Both giving you close to 5. All right. What is the reason that your short term is equals to long term? The reason could be uncertainty about economic conditions. We do not know what will be the movement of economy in future. It will go up, go down, no idea. No idea at all. So in this situation, we call it yield curve is flat. All right. Now, why yield curves are important? Let's talk about why these curves are important. We have several reasons for that. With the help of this yield curve, managers can decide the terms of borrowing or lending. Term means maturity or time period. With the help of this yield curve, you can make a plan whether you should be invest in a longer period or shorter period. If your yield curve is a normal, long-term investment is better. If yield curve is your inverted, short-term investment is better, right? Help in deciding borrowing or lending. Helps managers in deciding long-term investment or short-term investment. Not only investment, but borrowing as well. So that's why it's important. Now, we talk about one small things and then we go for break, right? Now we already understand the importance of yield curve. And with the help of this yield curve, we can predict the movement of interest rate. All right. But this movement of interest rate create a risk, that risk called exposure. All right. The movement of interest rate create an exposure for business profit. Means if those interest rates are increasing, then probably that increment will give positive impact on your profit or negative impact on your profit. This is called interest rate risk exposure, right? So let me write down here. Interest rate risk exposure means movement of, it means movement of interest rate risk affect business profit. Business profit. So means business profitability could be influenced by the movement of interest rate. For example, if borrowing let me write. If company borrow at variable rate, if borrow at fixed rate. Now, if company borrow at variable rate and if interest rate increase, okay, now what does it mean variable rate? For example, I borrow money from you, borrow money from bank. Bank has two options. Option one, bank will offer you fixed rate of interest. I borrow for 5 years and every year I have to pay return interest based on that rate. This is called fixed interest. In your total maturity period, your interest rate will not change. This is called fixed. Variable means bank offer you interest rate as per the market rate. And if in future market change, interest rate could be increased or decreased. It's about your luck. If you're lucky, if borrow at variable rate, if interest rate increase in a market, you will pay higher because you have to pay more. All right. So if borrow at variable rate and if it's increased, you have loss. You borrow at variable rate. If interest rate increase in a market, you have to pay more. All right. If you borrow at fixed and market rate reduce, you have to loss. You also have loss because you are paying fixed rate 5% for 4 years. Next year, market rate is 3%. So you're losing 2%. That's why you have a loss. Opposite thing apply. If you borrow at 5%, market rate become 4, you have profit. You borrow at 5%, market rate is 6%, you have profit because you are borrowing at low cost. All right? So low cost means high profit. So this is the idea behind the interest rate risk exposure and the importance of curve. Same rules apply. If you deposit money in a bank for longer period of time, if interest rate increase, you have opportunity cost. All right, so same rule apply here, right? So this is called interest rate risk management or risk exposure. Right? So now we go for break. Before break, anybody has any question? No question. So we can have a break. So next is interest rate hedging. Interest rate hedging. Now, what is hedging? Hedging means when company identify there is a risk exposure. When company identify there going to be a risk, then company understand how its impact on their profit. Means if I know that I involved in a long-term borrowing, and then but in the future maybe my interest rate going to I don't know, in a short period of time interest rate going to increase rather than a long period. So then I have to come in some hedging things. Now what does it mean, hedging? Hedging is a risk management strategy used by companies to avoid any kinds of subsequent loss. All right. So hedging, it's a risk avoidance strategy. Risk avoidance. So what company does? Company probably enter into any kinds of contract to avoid those kinds of hedging. So if you involve in hedging, any kinds of fluctuation in interest rate will not affect you. If you enter into a hedging, if any kinds of fluctuation in a market will not affect you. All right? Again, I said that fluctuation will not affect you. Affect you means if you go in market, you can make profit, but you will not make it if you are in a hedging contract. Hedging is not always give you profit. It's give you maybe loss as well, depends upon the market movement. All right. So we will understand these hedging things with some other terms that we will use to explain this. So hedging, how can we perform hedging? We can do many things in order to perform hedging. So it can be used for cash flow matching. Cash flow matching. Now, what does it mean? Cash flow matching. You know that We borrow money. We borrow. We borrow for what? We borrow money to invest, right? We borrow money to invest. When you borrow money, your cash inflow. And when you invest money, you have cash outflow. When you borrow, you have a time for how long you borrow. For example, 4 years. Now, will you invest for 4 years, less than 4 years, or more than 4 years? If you invest for less than 4 years, you will return less. If you will return less, do you think the return on investment help you to return borrow money? Maybe not. If you invest more than 4, then your maturity period will be after your borrowing maturity dates. Means after 4 years, you have to return money, but you get money after more than 4 years, 5, 6, 7 years. So what is cash flow matching? Cash flow matching means match the time to return money and the time when your investment get mature. When you match it. When you match it. This is called cash flow matching. I borrow money from bank for 5 years. So now I have 5 years to invest that money. So make sure I choose that investment when my 5-year investment finish, I have enough money to return money back to bank. So I'm matching it. This is the match called cash flow matching. Right? So cash flow matching, one of the technique, probably help to avoid the risk, because I borrow money from bank 7%. I have to find investment that gives me more than 7% in that specific time period. So I will make some investment strategy planning approach to do that. So that's the meaning of cash flow matching. But the problem with cash flow matching is, do you think it's practically possible? You're borrowing for 4 years and you are investing for exactly 4 years. Maybe practically it may not be possible. You may not have a right investment. You can easily get money, but you may not have a right investment that help you to recover money that you borrow from someone else. So practically is not possible. So there could be a gap analysis between your investment period and your maturity period to return money back to bank. Right? So this is the idea about cash flow management. Next is forward rate. Forward rate, that is very interesting concept. Forward contract or forward rate. Forward or forward rate. What is forward rate? Forward rate is the rate that is applicable to financial transaction that will occur in a future date. It has nothing to do with your current contract. So means I am signing with you for specific interest rate, and that interest rate maturity will be somewhere in future. Market rate up, down, it's about my profit, my loss. I sign a contract with you to lend you money, I don't know, at 8% rate, and you will return me money back after, I don't know, 5 years. 8% for 5 years. Regardless what is the movement in the market about interest rate, up or down, it will not affect us. That's the meaning of forward rate. So interest rate applicable to financial transaction. So forward rate is the rate that is applicable to financial transaction for future date. So this forward rate comes from market rate, we call it spot rate. This rate comes from market rate plus adjustment of borrowing rate. Borrowing rate. Now, what does it mean? For example, current market rate is 10%. All right, and I borrow money from bank at, I don't know, 11%. So 10% plus, for example, 2%. So my forward rate is 12%. So means I sign contract with you to lend you money or invest money in you, in your business or plan or to you at 12%. So means why 12%? Because market is 10% and I borrow at 11%. So 1% is my profit. So 12%, you will pay me 12% return for, let's say, 5 years. 5 years. If market interest is increased or decreased, my interest rate would be same because I signed contract with you for 12%. If market rate goes up, maybe I should consider as a loss because I'm losing opportunity to make more money. If market rate goes down, that would be more profitable situation for me. That's the meaning of forward rate. So I make some adjustment in order, this is just an example. So I'm just trying to give you example, how does this forward contract works. Now, move on to forward rate agreements. Now, you understand how forward rate works? Now, forward rate agreement. Forward rate agreement. Forward rate agreement means it's a contract between two parties. Contract between two parties to select a specific interest, like for example, 12%. There is a contract between you and me that I will pay you or I will invest money in you for 5 years and you will pay me 12% interest. This is called forward rate agreement. We call it FRA. FRA. So FRA, it's a contract between two parties. So what is agreement? It's a contract between two parties to exchange predetermined interest rate, for example 12%. For example, I'm writing here 12%, so you will keep connected with what we discussed in forward rate. So exchange interest rate for a specific period of time. Predetermined rate on amount for a specific period of time. Period of time. So we sign a contract with you that we make a payment and so on based on the interest rate that you and me have decided. So it means we are locking interest rate. We lock the interest rate to avoid any kinds of risk volatility. So we are means we are locking a future interest rate. Locking a future interest rate. Like for example, in our case, 12%. So we locked 12%. No matter whatever rate is in the market, we will not go with that rate. That rate will be just a reference point to know whether we are making profit or loss in our investment. Because if we would have been choosing those rates, we could have earned better return. But we avoid or we forget that kind of investment, right? So remember, these kinds of agreements generally happen with bank. Normally, these kinds of contract is not happen with the private people like it's you and me. It could be me and bank, or any other company and bank, not you and me, probably. So this is generally happen with bank, right? And the time period could be 1 month to 2 years. The amount could be greater than £1 million. All right. Amount is more than £1 million. It's happened with the banks and so on. And remember, in this option, it's very interesting. In this option is little bit different than borrow money. Remember that. For example, this is bank. all right? And this is borrower who needs money. So what bank does? Bank supply principal amount. Bank supply principal amount, and you return principal plus interest. But in your forward rate agreements, there is no any transfer of principal amounts because the purpose is simply investment. Right? Because we are simply using the reference point. Based on reference point, we enter into the two different contracts, 1 and 2, two different parties, and then we come up with our return. Right? So these are the basic information about it. Now let's have a look at the question. So let me give you the question. It's not a really question, but it's just a kind of example. So you will understand the language that we use it in this environment. So here is the kind of example to understand FRA. So it says that a treasurer of XYZ company expect that it will have to borrow approximately 5 million pounds for 3 months, starting in 2 months. The treasurer is concerned that interest rate may rise before he needs to take the loan out. So he can lock into interest rate today because again, the main reason for forward rate agreements to avoid any kinds of fluctuation in interest rate, to avoid any kinds of loss. He can lock into interest rate today by entering into FRA with a separate bank. This FRA would be quoted, for example. Now, we have to understand what does it mean? What does it mean 2V5? 2 means contract start in 2 months. And 5 means it will end in 5 months. It will start in 2 months and in 5 months. 5 is fixed interest rate. 5 is fixed interest rate. And 4.7 is expected future variable interest rate. expected future variable interest rate. Now, so remember, the fixed interest rate is 5. So which rate would he get? This on this. Means when he enter into the contract, at which rate will increase its money? 5% or 4.7%? 5%, because it's a fixed rate agreement. Remember that. 5% is the rate. And this is your reference rate. That reference rate helps you to get the idea you are making profit or you're making loss. All right. So what rate, which rate would he get? So he will get a fixed rate, right? He will get a fixed rate, which is 5. All right. So 5% would be the fixed rate. Now, it's time for a question. I'll show you this question probably here. Okay. So the question is, a treasurer has a £1 million loan and the current interest rate is set at 7%. Interest rates are negotiated every 6 months. After 6 months, they negotiate. And the next renewal date is in 3 months' time. He expects interest rate to rise and can obtain a fixed rate agreement at 7.1% for 6 months, starting in 3 months' time. What is effective FRA if interest rate eventually turn out to be 6.5 and 8%? So 6.5 and 8% is this number. So this is your fix. How much is this? 7.1. So what is the effect of this 7.1 if market rate goes 6.5, means below this? And what will be the effect of this rate if market rate goes above this rate? So we're gonna make a 2 columns. I don't want you to calculate this because it may be a little bit tricky. So I will create a 2 columns here. One column I will go with 6.5%. If market rate, which is reference rate, if it's below this, what will happen? If it's above this, what will happen? Effect means, what does it mean, effect? Effect means maybe profit or loss. They are saying effect. Effect could be profit or loss. That's the overall idea about fixed rate agreements. Hedging means Any kinds of fluctuations that we were discussing before somewhere here? Profit or loss that I discussed? That I discussed. Yeah, so here, the main idea is profit or loss. All right. So that's why we are checking whether these two types of rates will give any impact or not. So I am making a column here. So two columns here. So one column is about if interest rate is 6.5% and if interest rate is 8%. I repeat again for those who do not understand this question. Remember that this 6.5% and 8% is the market rate. So you enter into a contract with bank for 7.1%, which is fixed rate for 6 months period. All right. So if market rate goes 6.5%, what will happen? If market rate 8%, what will happen? So we will find out here. If it goes 6%, so let's calculate your interest rate. So let's find out your loan. So how much is your interest of 1 million pound for 6 months at the rate of 6.5%? Can you tell me? 1 million pounds, 1 million pounds, 6 months. How much would be your interest? How much interest? 6 months. No. Why 65,000? Cannot be 65,000. How much for 6 months? You are calculating for 1 year. 6 months. 1 million pound, 6 months, 6.5% interest. 6.5% is the annual rate. So 6 months would be 32,500. Everybody got it? If you 6.5%. If you borrow 1 million pounds for 6 months at the rate of 6.5, you have to pay 32,500. And how about 8%? It would be calculate for me and tell me.
40,000.
40,000. All right. 6 months, 1 million, 8%, interest would be 40%. Means if you do not enter into contract, you would pay this money for this, you would pay this money for this, right? Okay. But you enter into FRA. You enter into forward rate agreement. So forward rate agreements. So Can you tell me in this option, you losing money or you paying money? This option, what is this option? This is your, what is your contract? Your contract is 7.1%. And how much is the market? 6.5. Right? Right? And your time period is 6 months, which is divided by 2 probably, for 6 months. Are you making that money or you losing that money? Think again. Remember, it's a loan. At what rate you borrow? At what rate did you borrow? 7.1. And what market is offering? Other option or someone else or some other bank. What rate they are offering? 6.5. So you making or you losing? Losing. So how much? 7.1 minus 6.5. So how much money you are losing now? Calculate. 3,000. Everybody got it? 3,000? How you got 3,000? It's 1 million. 1 million pounds multiplied by 7.1% minus 6.5% divided by 2 or multiply by 0.5. Same thing. 0.5 means 6 months. All right. So you are losing it. You are losing it. So that would be 3,000. So if you go with second option, so this is your first option. If you go with second option is 8% minus 7.1% for 6 months. So it means 1 million pounds multiplied by 8% minus 7.1% for 6 months. All right. So how much is this? 4,500. So you are losing this money. Bracket. I put into bracket. So that means you are losing money. Wait. Let me read the question. Actually, treasurer doesn't have loan. Treasurer doesn't borrow the loan. Treasurer has a loan. So it means treasurer will invest this money. So this number will be opposite. So it means he is making 3,000, not losing 3,000. Yes. Sorry. Treasurer has a 1 million loan. He already has 1 million loan at 7%. He already borrowed this money. That's why he deposit into 7.1%. So he didn't borrow, he has this money. So let me write down here. So he has 1 million loan at 7% and enter into contract or FRA at 7.1%. So treasurer has 1 million loan, 7%, so he borrow at 7%. Now he will deposit that money at 7.1%, so 1% he can earn money. All right, so he did not borrow at 7.1%. He's investing at 7.1%. So means if he is investing at 7.1% and market investment rate is 6.5%, so he has profit, not loss. All right, so 3,000 would not be minus. So did you understand that, or I repeat again? This person already borrowed 1 million pounds at 7% interest. Now he entered into FRA at 7.1%. So means he borrow at 7%, and now he will invest. Borrow 1 million pounds. 1 million pound at 7%. Now he will invest this 1 million pounds at 7.1%. That's the question. That's the complete question. Now, if market rate goes to 6.5%, at what percent he invest? 7. Market is giving 6.5. Good for you or bad for you? Good. You're making profit. All right. Market is giving you 8%. You invest at 7, but market is offering 8%. This is bad for you. All right. So what does it mean? It means this is not losing here. So this is your profit and this is your loss. This is your profit and this is your loss, right? So that would be your loss. So total is 32 plus 32 plus 3, 35,500. And 40, 36, 35,000. So in fact, both options do not make difference for your final number. In both cases, probably you are making the same investment. Means if market rate goes up and down in this proportions, no matter you choose first option or you choose second option, in both cases your investment return would be the same, right? But anyway, in this question, this is not important. This is important, all right? This is important that you estimate it by this and this. The main purpose of this question is this: when you invest your money entering into FRA, whether you are making money or losing money. All right. So that's the idea behind it. We stop. This topic hasn't finished yet. Let me check what else is left. Option. Interest rate swap. We have two more things left: option and interest rate swap. Then this topic would be finished. So I think that in option and interest rate swap, just two more things are left. So hopefully we have class on Thursday. So Thursday before break, I will finish this option and swap things, and then we move on to probably exercise. Right?
If you search up the material about this line, this chapter on the book,